Hello and welcome to a Smaulgld special report on gold and silver manipulation. Today we're going to talk about gold and silver manipulation, not from a hypothetical point of view, not from a conspiratorial point of view, not from some strange looking trading behavior on the comics. We're going to look at actual documented gold and silver manipulation. This is part two of a report I did on gold and silver manipulation. Now, the first part dealt with the suspected gold and silver manipulation, the things that don't look right, the things that just seem that would not happen in a free market, one that wasn't manipulated, one that wasn't subject to intervention. But I thought I'd start the YouTube series by talking about the actual gold and silver manipulation that has happened, that has been proven. So we're going to give some examples of them. Now, I wrote this back in 2014, and since then, we did have in 2016 two cases where Deutsche Bank settled gold and silver price manipulation cases. Now, those cases are still ongoing, they haven't reached their conclusion, but the fact that Deutsche Bank settled is, I wouldn't say it is conclusive that there was manipulation, because when companies settle, they generally don't admit wrongdoing, they agree to help, and in exchange, they get off lightly. So that case will have those two cases, the Deutsche Bank gold and silver manipulation cases. We're going to have to follow and see where they lead with the co-defendants. But now let's go to some actual cases which have been proven. They're not in litigation. They're not, well, we kind of admitted it, but we didn't really admit it. These are real cases. And I've compiled them, and you'll be kind of surprised that for all this evidence, and God has done a terrific job of putting a lot of the documents together, and people still think it's a conspiracy theory. Of course it's not. Gold and silver, all markets are manipulated and need to be manipulated for various reasons. So, for example, interest rates. The fact that the Fed sets interest rates is a form of market manipulation. They set the price of money. You need to go no further than that. The fact that the Federal Reserve interferes in markets, prints money, buys treasury bonds, buys mortgage-backed securities at below market prices, or I mean above market prices. The fact that the Swiss National Bank buys U.S. equities is there, again, evidence of market manipulation. But we're going to talk about gold and silver specifically. Not just that there's manipulation of markets. I mean, there's LIBOR manipulation. They've proven that. But they always seem to think that, well, if there is manipulation, it happens everywhere else, but it never happens in gold and silver. Hold on a minute. In 1934 to 1971, after Roosevelt basically banned the private ownership of gold in the United States and stopped making U.S. coins out of gold, the price of gold was set by the Gold Reserve Act of Congress in 1934 at $35 an ounce. Now, I can't think of a greater manipulation than that, where Congress gets together and says, let's think, why don't we just make gold $35 an ounce? And it was set at $35 an ounce, and there it stayed from 1934 to 1971 through the Bretton Woods agreements, through the gold standards of the United States, and they try to keep that price at $35 as they set it, irrespective of what the free market price of gold might have wanted to go to. Now, because gold and silver have long histories as monetary metals, and gold was most recently backing the US dollar from 1944 to 1971, and silver was the basis of coinage across the world, in the Western world, Australia, England, Canada, France, Mexico, the United States, all had silver coins in circulation. So, because precious metals have been used as money, as mediums of exchange, central banks need to control the price of both metals. Now, when gold and silver were legally recognized as money, central banks needed to fix or substantially control their prices. And that need is even more necessary today, as gold and silver aren't seen as anchors to government currencies, but rather as competition. As such, central banks are going to go to great pains to control these prices. And they'll also go to great pains themselves and their media cohorts to explain that gold and silver are not money, that basically they are trinkets. In fact, when Nixon took the United States off the gold standard or off the Bretton Woods Agreement in August of 1971, the story then was that gold prices would plummet. Why? Well, if gold wasn't needed as part of the monetary system, then the only use of gold would be for trinkets and jewelry. And therefore, with that monetary demand gone, the price of gold will fall. Well, that's not true. That's not what happened. Gold became more valuable as a result of the going off the gold standard, more valuable as a reserve asset for central banks. So if gold and silver only used as industrial metals or just for jewelry, then central banks would have little interest in them. Everybody remembers the famous, I guess it was a congressional testimony, and Ron Paul was classic during these. He used to always get Ben Bernanke going, and he had Ben Bernanke up there, and he asked him, why do central banks hold gold? And Bernanke said, well, and then Ron Paul said, is it because it's money? And then Bernanke thought for a second. He said, no. And then Ron Paul said, well, then why do they hold it? And Bernanke said, tradition. And then Ron Paul said, well, I gotta go. My time is up, but I still think it's money. Central banks go out of their way to either ignore gold, or to deny that it's money. In fact, if you look, I took a look at the Federal Reserve speeches over the last 10 years. They don't mention gold. They don't mention it at all. The only time it gets mentioned is someone brings it up. But on their own, if they go give speeches, if they write about something, they talk about something, whatever they're talking about, interest rates, inflation, job market, whatever the economy is, they never, ever, ever mention gold. The president never mentions gold. The United States president never mentions gold. But you see, Russia and China, they make pronouncements about gold all the time. They announce their gold holdings. Think about the United States. They have not changed their gold holdings since 1971, 1972. And up until then, they had been losing gold for the last 10 years before they went off the gold standard. And ever since then, the United States has taken the view that the dollar is what people need to know about. So basically, they don't discuss gold. Now, let's take a look at some of these concrete examples of silver and gold manipulation by U.S. presidents, Congress, Federal Reserve, U.S. Treasury, central banks, and private banks, sometimes solely or in conjunction with each other. Let's look at presidents. Now, Richard Nixon once famously said, when the president does it, that means that it's not illegal. Okay, well, there's your imperial presidency. Let's start with Franklin Delano Roosevelt. He himself used to fix the price of gold after his executive order ordering the confiscation of gold of United States citizens. So we had written an article called Think the Fed Destroyed the Dollar. And we wrote, in 1933 in April, with a stroke of a pen, FDR issued Executive Order 6102 requiring U.S. citizens to turn in their gold coins and gold bullion and gold certificates to the government. At the time, gold coins were circulated in the United States and gold was considered money. A dollar was tied to a gold rate of $20.67 an ounce. Under Roosevelt's order, the government honored the $20.67 an ounce. You turned in your gold, your jewelry, whatever it was, or your gold coins. They gave you the US dollars of $20.67 an ounce in exchange for gold. But after issuing Executive Order 6102, Roosevelt began stockpiling gold from mining companies and from foreigners. In the months following the issuance of his executive order, and I read this in Raw Deal, New Deal or Raw Deal by Burton Folsom, He used to sit down with future Secretary Treasury Henry Morgenthau, and they used to say, "Oh, what do you think the price should be of gold?" And they would say, they just kept nudging it higher and higher. And in one instance in the book, Morgenthau suggested a price rise of 19 to 22 cents per ounce, and Roosevelt thought, let's pick 21 cents because that's a lucky number. So here you got two guys sitting around their pajamas figuring out what the price of gold is going to be. And then, after they played with gold on their own from May or April of 1933, in January of 1934, as I mentioned, Congress passed the Gold Reserve Act, which changed the nominal price of gold from $20.67 an ounce to $35 an ounce, providing the Roosevelt government with a tidy 69% gain on their confiscated gold and a loss of 41% in the purchasing power of the dollar. And remember that 41% devaluation of the dollar meant anybody who turned in their gold at $20.67, well, they lost the difference between $20.67 and $35. As I mentioned, that $35 price an ounce, excuse me, remained in place until 1971 when Nixon unilaterally took the U.S. off the gold standard and closed the gold window. Let's take a look at silver. Here's another actual example of silver price fixing by a president. Many of you know that pre-1965 coins are 90% silver. Dimes, quarters, half dollars, and dollars are minted as 90% silver. Well, in 1965, the U.S. had decided, as part of the process of demonetizing silver, that the dimes, quarters, and half dollars would no longer be minted of 90% silver. Instead, they'd be these clad coins of the sandwich of this copper and nickel alloy, where they'd put the two together. It'd be nickel on the outside, kind of copper on the inside. But they were going to be stamped 10 cents, 25 cents, and a half dollar. Now, Johnson knew that people would think, they get the bright idea, you don't have to be too bright to realize Gresham's law, that if there's a quarter dated 1965 that is 90% is copper nickel, and there's a quarter dated the year before 1964 that's 90% silver, well, you'd probably want to hold on to the 64 quarter and you'll spend the 65 quarter. And any chance you get, you probably want to take all those silver quarters and hold on to them because they're worth more than the copper nickel quarters. Well, Johnson had a plan, and he said, no. He basically was saying, look, those coins are worth 25 cents. Doesn't matter whether they were minted in 1964 or 1965. They're still 25 cents. I don't care about the silver content. And so, when he signed the act in 1965, remember, they made silver coins in 1965. But they were dated 1964 because what they were trying to do, and I'll show you a chart in a second. What they were trying to do was flood the market with silver coins dated 1964, so they would appear even more numerous than the copper nickel coins, so people wouldn't hoard them, and it would just be very difficult to hoard them to gain financial advantage if there were so many of them. But Johnson explicitly warned Americans not to hoard the coins. And he coupled that with the threat that the United States, with the assistance of the U.S. Treasury, would flood the market with silver to ensure the price of the silver would not rise and that you wouldn't gain anything from pulling those silver coins out of circulation. So when when Johnson, here are the remarks he made when he signed the Coinage Act of 1965 that removed that silver from the coins and replaced it with the copper nickel mixture. He said, quote, if anybody has any idea of hoarding our coins, our silver coins, let me say this. This is not a Lyndon Johnson imitation. Treasury has a lot of silver on hand, and it can be and will be used to keep the price of silver in line with its value in our present silver coin. There will be no profit in holding them out of circulation for the value of their silver content. Well, yeah, there was. There was a big value in hoarding those coins out of circulation for the value of their silver content. So try as they might have, the Treasury may have flooded the market with silver, but it did not prevent the people from hoarding the silver coins. And all that silver is now gone. The United States no longer has a silver stockpile. It's all gone. Now, here's what I was talking about. In 1964, the U.S. Mint just went nuts. They produced 4 billion coins, dimes, quarters, and half dollars. And they used over a half a billion ounces of silver that year. They used 550 million ounces of silver. That's basically, when you get all excited, oh, the U.S. Mint had a record year in 2015. They sold 47 million ounces of silver in the form of silver eagle coins. So what? From 1986 to 2015, they used about the same amount of silver as the U.S. Mint used in 1 year. And if you think about it, then they sold those coins to those American silver eagles. This half a billion ounces worth of silver, half a billion plus, was used not to sell you anything, but just to put the coins in circulation for you to use. It's quite an amazing year in the history of silver coinage. Well, let's go to another president, Richard Nixon. We talked about this before, 1971. He just announces that the United States is no longer going to abide with the terms of the Bretton Woods Agreement of 1934 and the Bretton Woods Agreements of 1944, which provided that the U.S. dollar, which was the world's reserve currency, pursuant to those agreements, under which the dollar would be convertible to any central bank who was a signatory to those agreements into gold if they so desired. Well, what happened was a lot of countries so desired that they would rather have gold than the dollars that they might have accumulated in trade with the United States and in trade around the world. So certain countries who had accumulated large amounts of dollars decided they were going to turn those dollars in and get gold, as was their right under the Bretton Woods Agreement. And finally Nixon realized, we're going to run out of gold here. We ourselves, the reason that a lot of the countries wanted the gold was they realized the United States was spending a lot of money. They were starting to do deficit spending, which the United States used to have a surplus, at least on a trade, from a trade perspective. But now the U.S. in the 60s was deficit spending on Vietnam War, Lyndon Johnson's Great Society, the space race, the Cold War, and France, Germany, Switzerland, among others. Those countries realized they may not be able to back all of this with gold, so we're going to come and collect our gold. And then they continued to increase their request for gold, and finally Nixon said enough and closed the gold window. Now, post-Bretton Woods, the dollar is no longer tied to gold, and therefore that artificial price of $35 an ounce set back in 1934. And the idea was, if gold was no longer part of the global monetary system, that the demand for gold would plunge. Well, it didn't. A lot of foreign banks wanted to hold on to gold and actually wanted to increase their gold reserves. But gold, they thought, would be relegated to trinkets, dentistry, and jewelry. And so, at the end of 1974, they passed legislation in early 1974 that they would allow U.S. citizens for the first time since 1933 to own gold again. But as we've talked about in other YouTubes, and also I think the YouTube is called "What is the Real Purpose of the Gold Futures Market?" They also simultaneously are concurrent with the removal of the gold prohibition of ownership by U.S. citizens. They introduced a gold futures market, and the idea there was that a gold futures market, because it would be volatile and because it would be convenient to hold gold via paper contracts, that it would discourage physical ownership and hoarding. And that's kind of exactly what it did. But Nixon's act was monumental. It purported to substitute the value of a dollar backed with gold with a dollar backed by nothing. And they managed to get away with it. I mean, the Bretton Woods Agreement, which was a supposed gold standard from 1944 to 1971, lasted less in time, temporarily, than the current system, which is 100% fiat. And it's not just that the United States is on a non-gold, unbacked fiat system. The whole world is. But that's, of course, because Nixon and Kissinger worked out the petrodollar agreement. We're not going to get into that now. If you're interested in the petrodollar agreements, I'll leave a link to this particular blog post on gold and silver manipulation. There's links within this blog post that will take you further into your research. Now let's get into more gold manipulation, actual gold manipulation by central banks. Now we've talked about how We suspect that there's some of the delivery of physical gold on the LBMA, which is in London, is done by borrowing other clients' gold held by the Fed, the bullion banks, and looting of the gold trust like ETF. But we don't have any evidence of that. We just speculate that that has happened. And the idea that the Fed is involved in a scheme where it would lease gold or sell gold that is held in custody for others in order to suppress the price. Remember, the Fed holds gold for other countries, has done since the end of World War II. The idea that they lease that gold out, we suspect they do that, but we don't have any proof that they do that. However, we do, because Alan Greenspan, El Maestro, he was a gold bug before he came in to become the Federal Reserve, before he became the maestro. He was a huge gold bug. In fact, in 1966, he wrote in Ayn Rand's journal, deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. So he was clearly a sound money guy. But in July of I think it was 1998, in sworn testimony to Congress, he said, central banks can and will manipulate the gold market if necessary. He said, nor can private counterparties restrict supplies of gold, another commodity whose derivatives are often traded on the over-the-counter, where central banks stand ready to lease gold in increasing quantities should the price rise. Now, while this wasn't an admission that the Fed, which is a central bank, would itself engage in any such gold leasing, but it was a statement of fact that other central banks certainly would if required, and I would think it's no stretch of the imagination to see the Fed participating in this type of manipulation. Now, the price of gold in 1998 was about $295 an ounce, and practically no one was paying attention to it. But the price of gold since then has risen to a ridiculous amount. We're complaining now that the price of gold has come down from 1900. Remember where it came from in 1998. It was like $295, $300 an ounce. It soared all the way up to 1900. And in fact, I remember in 2008, there was this guy Robini saying that when gold was $700, $800, that $1,000 was ridiculous. $1,200 was like the silliest thing you'd ever heard. Well, that's gold may have risen past his point, but gold is stabilized around the $1,200 mark. So other central bank coordination of gold, the price of gold, proven. First of all, you had the London Gold Pool. It was established in 1961. It was established by 8 central banks. They agreed they would pool their gold reserves and coordinate efforts in order to maintain the $35 an ounce gold price as contemplated by the Bretton Woods Agreements of 1944, based on the Gold Reserve Act of 1934. So here you are, late in the 1960s. You've got central banks trying to keep the price of gold at the price that was set by Congress in 1934. And eventually that scheme proved unworkable by 1968, but from 1961 to 1968, these central banks managed to keep a lid on the price of gold through agreed coordination for 7 years. Bank of England sells 400 tons of gold from 1999 to 2002 at the bottom of the market. Now, this seemed like a boneheaded move. Future UK Prime Minister and then UK Chancellor of the Exchequer, Gordon Brown, sold most of England's gold at prices between $250 to $300 an ounce. Why? Trying to keep the price of gold down. That was called Brown's bottom. Currently, central banks have gold agreements amongst themselves. You can click here. You can see there's the most recent, dated May 19, 2014, provides that European central bank signatories agree. This is an agreement. Gold remains an important element of global monetary reserves. Now, they admit that there, but they never admit it publicly. But amongst their agreement, in their agreement, that's what it says. And it says, signatories will continue to coordinate their gold transactions so as to avoid market disturbances, i.e., rising prices. Signatories note that currently they do not have any plans to sell significant amounts of gold, and this agreement, which applies as of 27 September September 2014 follows the expiry of the current agreement, will be reviewed after 5 years, which means that the central banks have had agreements in place for years. There was an agreement before the 2014 agreement. This agreement takes us all the way up to 2019. So they agree what to do about gold. That's manipulation. Silver manipulation. Silver and gold price fixing by acts of Congress. Now, we talked about the 1934 Gold Reserve Act, where gold was set at $35 an ounce. Well, 1918 Pittman Act. Congress ordered the destruction of 270 million silver dollars to support the price of silver. Now, this in the Pittman Act, we've talked about this one before. 270 million already minted Morgan silver dollars will be rendered into bullion as an act to conserve the gold supply of the United States, to permit the settlement in silver of trade balances adverse to the United States, to provide silver to subsidiary coinage and for commercial use, and to assist foreign governments at war with the enemies of the United States, and for the purposes to stabilize the price and encourage the production of silver. This was introduced by I think it was Las Vegas, but he was a Nevada senator, Pittman. And they figured, look, we melt down this silver, the Nevada silver mines got to produce more. So it was a stimulus package. It was also designed to manipulate the price of silver. But the real purpose of the Pittman Act was to help Great Britain, whose money in the pound sterling was backed by silver. England was facing a silver shortage for minting rupee coins in its colony, India. And it had serious war debts from the Great War, World War I. So the act provided for the sale of about 260 million ounces of silver to Great Britain at $1 an ounce. The Pittman Act helped Great Britain avoid a collapse of India and possibly Britain's economy. Now, destroying those 270 million silver dollars and selling the recast silver bullion to India helped the U.S. ally and also helped boost the price of silver by supporting the U.S. mining industry by providing that the 270 million silver Morgan dollars that were destroyed would be reminted using silver from U.S. mines to be purchased at $1 an ounce. Under the Pittman Act, between 1920 and 1933, silver required to mint another 270 million Morgan silver dollars and peace silver dollars was purchased from the mint at a fixed price of $1 an ounce. The fixed price of $1 an ounce was above the market rate of 86 cents an ounce, or about 16-20% higher. Let's look at manipulation by the U.S. Treasury. The Exchange Stabilization Fund was established by the Gold Reserve Act of 1934. The Exchange Stabilization Fund was created and originally financed by the Gold Reserve Act of 1934 to contribute to exchange rate stability and counter disorderly conditions in the foreign exchange market. Getting Congress to agree or act quickly then and now was often difficult, so this Exchange Stabilization Fund was set up to give the Treasury the power to manipulate markets subject to the President's approval. So the United States is authorized to use the Exchange Stabilization Fund to manipulate whatever market it deems necessary in the interest of the nation. Repeat. The United States Treasury is authorized to use the Exchange Stabilization Fund to manipulate whatever market it deems necessary in the interest of the nation. The Gold Reserve Act authorizes Secretary of Treasury to deal in gold, foreign exchange, securities, and instruments of credit under the exclusive control of the Secretary of Treasury, subject to the approval of the President. The Gold Reserve Act of 1934 initially funded the Exchange Stabilization Fund with resources resulting from the devaluation of the dollar in terms of gold when Congress voted to raise the price of gold from $20.67 an ounce to $35 an ounce. Now, the Treasury and the Fed have never publicly admitted to interfering in the gold markets, although it would seem reasonable since authorization exists should the need arise. Now, James Turk of Gold Money, however, uncovered evidence from a Federal Open Market Committee transcript from 1995 regarding using the Exchange Stabilization Fund to intervene in the gold market. Here's what he wrote. A transcript of the Federal Reserve Market Open Committee has been released, which somebody forgot to get his or her red pen out. Someone forgot to redact some very revealing words about the Exchange Stabilization Fund and its activity with gold. Here's what was said. Mr. Madley, it is pretty clear that the Exchange Stabilization Fund operations are authorized. I don't think there is a legal problem in terms of authority, because there is an Exchange Stabilization Fund Act. The ESF statute is very broadly worded in terms like words like credit. It has covered things like the gold swaps, and it confers broad authority. Now, look at the statement again. Maybe even a third, fourth time. This statement, which I can only assume was inadvertently not redacted by the FOMC Secretariat, confirms what we already know. But the U.S. government has all along refused to admit that the Exchange Stabilization Fund is involved in the gold market. In fact, the authority of the Exchange Stabilization Fund is so broad that it's covered things like gold swaps. In other words, the authority of the Exchange Stabilization Fund is so broad that it's even been used to authorize gold swaps. Another one besides the Exchange Stabilization Fund is the Plunge Protection Team. The Plunge Protection Team was created after the stock market crash of 1987. Reagan signed an executive order establishing the President's Working Group on Financial Markets. Here you got Reagan, Mr. Free Market Reagan, and Mr. Goldbug Alan Greenspan working together to create this market manipulation plunge protection team, which basically allowed this team, which included the Secretary of Treasury, the Chairman of the Board of Governors of the Federal Reserve, the Chairman of the SEC, and the Chairman of the Commodities Futures Trading Commission to work together to enhance the integrity, efficiency, orderliness, and competitiveness of our national financial markets and maintain investor confidence. What does all that gibberish mean? It means that the stock market is very, very important to the United States economy. It's very, very important for the United States to maintain that it is the preeminent stock market in the world. So next to the dollar, I would say the U.S. stock market is one of the premier, not premier, but one of the most valued assets that the United States have. After all, how else can you have the United States stock market? You have companies that make no money, and yet somehow they make billions of they're worth billions of dollars. If they were on another exchange, they would not be worth billions of dollars. They'd be valued on the basis of their earnings. So U.S. companies, and if you think about it, they get not only does the dollar get to be overvalued, but U.S. stocks get to be overvalued because there's a plunge protection team that is ready to stand and inject liquidity in case the U.S. stock market falls. That's another reason why we have not had a prolonged stock bear market since 1987, since the creation of the plunge protection team. We have not had 6 months, a year of bad stock market returns. No, you get the stock market goes down for a couple of days and then boom, it goes right back up. Since 1987. Now I remember a time in the 70s, stock market was down for like 6, 7, 8 years. That was normal. Prolonged, protracted bear market. Companies aren't making money. Stock market doesn't do well. Today, companies aren't making money. It doesn't matter. So what? They've got eyeballs. They've got something that we can give them value. Snapchat. All right. Manipulation using gold held by ETFs. Now, ETFs are a great way for investors to gain exposure to the price of gold, not to hold gold. They have the advantage of being traded on the stock exchange, so investors can buy gold without having to take delivery, insure it, store it. Fine, you don't get any gold, but you get exposure to the price of gold. And you can sell it with a mouse click. But because of this, ETF custodians who store the gold on behalf of shareholders, they can also take advantage of the gold that is held. Because ETF shareholders generally cannot and usually don't want to take delivery of gold because it usually takes a large amount, and basically they're happy having someone else store it, insure it, and basically all they want is the fiat profit, so they don't care. They never even see the gold. But because gold and silver ETFs put physical gold under the control of banks, they can theoretically lease or sell it. The largest one is GLD, which is the custodian HSBC. And the largest silver one is SLV, and the custodian of that one is JP Morgan. So, it's possible, and again, this one is speculation that they lease out that gold, but forget speculation. Let's give you an actual example of manipulation of ETFs in India. Indian gold ETF run by Goldman Sachs changes rules to allow it to lease gold. Bingo. So you buy an ETF in India under this particular Goldman Sachs GS Gold BES. It's got written rules. It says explicitly They can lease out their gold. Well, there you go. So it's not like you have to suspect via Paul Craig Roberts that they're doing a GLD. Or maybe they are, maybe they aren't. Doesn't matter. This Indian one just explicitly allows them to. Here, private metal price fixing and shenanigans by private banks. Barclays fixes the price of gold. On the day after Barclays, one of the LBMA banks was fined for manipulating LIBOR. One of its traders fixed the price of gold. Now, of course, they try to say that this guy was acting on his own, but he actually, this guy, Daniel Plunkett, he settled for a fine, only £95,000, but basically he manipulated gold and he admitted it. Now, they try to make it sound like he's an individual trader, but the point is, it was a proven case of manipulation, and if a trader could achieve this type of manipulation, I argue it's conceivable he isn't the only one. Now, many of you know this story. Morgan Stanley sells precious metals to customer, charges storage fees, but has no precious metals when customers request delivery. In a lawsuit filed in 2005, Morgan Stanley was accused of selling clients precious metals that they would own in full and Morgan Stanley would store it for them. Well, when the people went to get their gold, they were told, you'll have to wait. It may take long. Whoa, what do you mean have to wait? I pay every month. You should have them. Let's hand them over. They offered them to pay them cash. They said, no, we want the gold. Morgan Stanley settled the case, and they said, we denied the allegations, but we settled to avoid the cost and distraction of continued litigation. Now, I'm going to call BS on that because the easiest way to say the allegations are false when someone says, give me the gold, is to give them the gold, because if you give it to them, they have no complaint. But when you can't give it to them and you offer to pay them money instead, you're admitting that the plaintiff is correct, that you're unable to deliver what you said you were storing for them. But in any event, they managed, and the people are smart there. And here's the thing. If I had money, if I had sent money to Morgan Stanley and I thought they bought gold for me and I thought they were holding it for me, I'm really not going to make a big deal out of it. What I'm thinking is, give me the value of it. I'll get my money back, and then I'll go buy it and store it somewhere else. I'll make sure this time that I'm not just taking the word of Morgan Stanley. The other thing is, and this is manipulation, I mean the press, but negative research reports on gold from the bullion banks. You have here, this is 2014, Bank of America slashes gold forecast, could plummet to $1,000 an ounce. No, it didn't. You have all these reports coming out. This is in 2014. I was covering these. Goldman Sachs stands by 10.50 an ounce gold price for 2014. That didn't go anywhere near 10.50 in 2014. Societe Generale sees 2017-2019 gold price average of $8.25 an ounce. Now they put this out to influence the markets. The media does the same thing. Now you can't prove that Bloomberg, Reuters, AP are in on it, but they really do a good job of constantly trashing gold. And then you got guys like Warren Buffett and Charlie Munger with their famous quotes. Here's Charlie Munger, Buffett's sidekick. I don't see how you become rational hoarding gold. Even if it works, you're a jerk. That's what he says. And this. Gold is a great thing to sew into your garments if you're a Jewish family in Vienna in 1939. I mean, the disdain there is incredible. And, Warren Buffett and Charlie Munger, they benefited from government bailouts. The guy bought Goldman Sachs before the financial crisis, basically as an insurance, knowing that if it did collapse, he'd get taken care of, and he did. And then Warren Buffett has this silly quote, gold gets dug out of the ground in Africa or someplace, then we melt it down and dig another hole, bury it again, and pay people to stand around guarding it. Anyone watching from Mars would be scratching their head. Yeah, anyone from Mars would be scratching their head watching you stuff your craw with a Big Mac and a Coke, too. So what are you doing? So in any event, Buffett gets a lot of credit for being some type of tremendous investor. I think he lost his investment prowess decades ago and became a crony capitalist, but that's another issue. Here's what he says. If you take gold, you own, melt it down into a cube, and check back years later. He observes that the cube will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. But that's a true statement. And that's true. Gold isn't supposed to do anything. The fact that that's the advantage of gold. Gold is, it always is. It's inert. The value sits there. It is there. You don't have to worry that someone has to do anything. So when Warren Buffett compares gold to a productive asset, he's comparing tiddlywinks to check. I don't know what he's doing. There's not even apples and oranges. He's just basically saying gold is a lump of value. Okay, that's what it is. So he's confusing gold, and he does it on purpose. Anyway, those are some of the actual silver manipulation things that we've seen. They're proven. They happened, and they have to happen. If you think about it, they have to manipulate gold. They have to manipulate silver because they're competition to the confidence of the fiat currency system. Thanks for listening.